In the last chapter, we learned to mark supply and demand areas. Now we slow down and look inside those areas. When price reaches an important zone, the candles begin to tell a smaller story. Are buyers responding? Are sellers still in control? Is price rejecting the area, accepting it, or breaking through it? Candlestick behavior is not about memorizing names. It is about reading pressure one candle at a time. A candle is a summary of what happened during a period of time. It shows where price opened. It shows how high price traded. It shows how low price traded. And it shows where price closed. That closing price matters because it tells you where the candle finished after buyers and sellers pushed against each other. One candle does not explain everything, but it can give useful evidence when reading context. The body of a candle shows the distance between the open and the close. A large body often shows stronger movement during that candle. A small body often shows less commitment. The wicks show where price traded but did not stay. An upper wick means price traded higher, then moved back down before closing. A lower wick means price traded lower, then moved back up before closing. The body and the wick should be read together. A bullish candle closes above where it opened. That means buyers controlled the final direction of that candle. A bearish candle closes below where it opened. That means sellers controlled the final direction of that candle. This does not mean one green candle changes the whole market. It does not mean one red candle changes the whole market. The candle color is only one piece of evidence. Context decides how important that evidence is. Wicks are often used to read rejection. If price trades below a demand area and then closes back above it, the lower wick shows that sellers pushed lower but could not hold it. If price trades above a supply area and then closes back below it, the upper wick shows that buyers pushed higher but could not hold it. The wick is not magic, it simply shows that price tested an area and was pushed back. Where a candle closes is very important. A candle that closes near its high shows buyers finished strong. A candle that closes near its low shows sellers finished strong. A candle that closes near the middle is less clear. The close tells you who had control near the end of that period. That is why two candles with similar wicks can mean different things. Always ask where the candle finished, not only where it traveled. Candles must be read in context. The same candle can mean different things in different places. A bullish candle at demand may show buyers defending an area. A bullish candle into supply may only show price reaching sellers. A bearish candle in a downtrend may continue the trend. A bearish candle into demand may be the candle that tests buyers. Before you judge the candle, judge where it happened. Strong candles tend to have larger bodies, cleaner direction, and less overlap. Weak candles tend to have smaller bodies, more overlap, and more back and forth movement. This is not about one perfect candle, it is about the behavior of price. If candles push away from an area with strength, pressure is clearer. If candles barely move away, pressure is weaker. The cleaner the behavior, the easier the chart is to read. Candlestick behavior becomes most useful near important areas. At demand, you watch whether candles show rejection, slowing selling pressure, or buyers stepping in. At supply, you watch whether candles show rejection, slowing buying pressure, or sellers stepping in. The area tells you where to pay attention. The candles help you read the response. When the area and the candle behavior agree, the story becomes cleaner. One useful idea is follow-through. A rejection candle is more meaningful when the next candles continue in the rejection direction. For example, price may wick below demand and close back above it. That is interesting. But if the next candle also moves higher, the response is stronger. Follow-through tells you the market did not only reject once, it continued to respond after the rejection. Not every reaction works. Sometimes price wicks from an area, but the next candles fail to follow through. Sometimes the wick looks strong and then price breaks the zone anyway. That is why candles should not be used as automatic signals. A failed reaction is still useful information. It tells you the first response was not strong enough. When the follow-through fails, the story changes. Many beginners memorize candle names before they understand candle behavior. They learn terms like engulfing candle, pin bar, doji, and hammer. Those names can help, but names are not signals by themselves. The main point is pressure and context. A candle matters when it appears at a useful area. Look at where it formed. Look at where it closed. Then look for rejection and follow-through. When the pressure is clear, the candle name is secondary. Indecision candles often have small bodies and wicks on both sides. They show that price moved up and down, but neither side finished with clear control. In the middle of a range, this may simply confirm a messy market. Near a major area, it may show hesitation before the next decision. Indecision is not automatically bullish or bearish. It means the candle did not give a clear answer yet. Momentum candles have larger bodies and usually close near one end of the candle. A strong bullish momentum candle closes near its high. A strong bearish momentum candle closes near its low. Momentum can show that one side is taking control. But location still matters. A strong candle breaking out of a range is different from a strong candle running straight into supply. Momentum is evidence, not permission to ignore context. In a trend, candles can help you judge whether the trend is healthy. In an uptrend, the impulse candles may be stronger than the pullback candles. In a downtrend, the selling candles may be stronger than the bounce candles. That difference shows which side is applying more pressure. If the pullbacks become stronger than the impulses, the trend may be changing character. Candles help you see that change earlier. In a range, candle behavior often matters most near the edges. Near the range low, you watch whether selling slows and buyers reject lower prices. Near the range high, you watch whether buying slows and sellers reject higher prices. In the middle, candle signals are usually less useful. There's less room and more noise. The edge gives the candle behavior a clearer place to matter. Do not read candles one at a time forever. Read the sequence. First, price reaches an area, then a candle tests it, then another candle shows whether the response continues. Then price either builds structure, pauses, or fails. The sequence is more useful than one isolated candle. Candlestick behavior is the story of several candles working together. Time frame changes the way candles look. One large higher time frame candle may contain several smaller lower time frame candles. That means lower time frames can give detail, but they can also add noise. Start with the time frame that shows the area clearly. Then use the lower time frame only if it helps you read the response. Do not zoom in until the chart becomes so detailed that the main story disappears. Here's a simple workflow. First, identify the important area. Second, watch the candle behavior inside that area. Third, check where the candle closes. Fourth, look for follow-through. Fifth, compare the response with structure area. Candle, close, follow-through, structure. That order keeps you from treating one candle like a complete trading plan. The common mistakes are easy to spot. The first is memorizing candle names without understanding pressure. The second is reading candles away from important areas. The third is ignoring where the candle closed. The fourth is entering ideas before follow-through appears. The fifth is forgetting the market condition. Candles are useful when they clarify the chart. If they make you chase every small movement, simplify the read. Let us recap. A candle shows the open, high, low, and close for a period of time. The body shows the open to close movement. The wicks show where price traded but did not stay. The close shows who finished stronger. Context decides whether the candle matters. Follow-through confirms whether the response continued. Candlestick behavior is not about magic names. It is about reading pressure in context. Candlestick behavior gives us a closer view of pressure. Now we can combine it with levels, structure, and supply and demand. That prepares us for the next chapter. Break and retest. When price breaks an important area, the story is not finished. The return to that area can tell us whether the break is being accepted or rejected. In the next chapter, we will study that sequence step by step.